The banking crisis of 2023 has shaken the confidence of many customers and investors in the financial system. The collapse of three mid-sized banks, Silicon Valley Bank, Signature Bank, and First Republic Bank, in a span of 2 months has exposed the vulnerabilities of some lenders to rising interest rates, falling bond prices, weak commercial real estate markets, and a slowdown in the tech sector. These events have created uncertainty and tightened credit conditions for households and businesses, which could weigh on economic activity, hiring, and inflation. Uncertainty is a major factor that affects consumer and business spending decisions. When people are unsure about the future, they tend to save more and spend less. They also postpone big purchases, such as cars, houses, or equipment. Businesses are less likely to invest in new projects, expand their operations, or hire more workers. This reduces the demand for goods and services in the economy, which lowers economic growth and employment. Tightened credit conditions are another consequence of the banking turmoil. When banks face losses or liquidity problems, they become more cautious about lending money. They may raise interest rates, tighten lending standards, or reduce credit availability. This makes it harder for households and businesses to borrow money or refinance their existing debts. For example, some homeowners may find it difficult to refinance their mortgages at lower rates, which could increase their monthly payments and reduce their disposable income. Some businesses may struggle to obtain loans or lines of credit, which could limit their working capital and cash flow. The combination of uncertainty and tightened credit conditions could also have an impact on inflation. Inflation is the general increase in the prices of goods and services over time. It is influenced by many factors, such as supply and demand, production costs, monetary policy, and expectations. When economic activity slows down, demand for goods and services falls, which puts downward pressure on prices. However, when credit conditions tighten, supply of goods and services may also fall, as businesses face higher costs of borrowing or lower access to financing. This could push up prices. Moreover, when people expect higher inflation in the future, they may demand higher wages or increase their spending now, which could fuel inflation further. In summary, the banking turmoil of 2023 has created uncertainty and tightened credit conditions for households and businesses, which could weigh on economic activity, hiring, and inflation. These effects could vary depending on the severity and duration of the crisis, as well as the policy responses from the government and the central bank.